Welcome you to today's webinar. Today we are going to discuss an important aspect of technical analysis, and where probably most of us get frustrated because a lot of technical trend traders normally go with breakouts. Now, normally the easiest and simplest mechanism for trading is to follow your trend and is to look towards breakout of some highs or bottoms. If an important high is broken, then long position is taken. If an important bottom is broken, then in that case, they go for a short position. So that is how normally the trades are taken on a technical basis on a trend, in a trend following system. But what happens in a lot of cases is that what looks to be a breakout, immediately there seems to be some reversal and stop losses get triggered. So this is a frustration for traders. Those who are following trend following based on moving average, normally initially when you get started, you may say that break down below a 20 moving average for illustration, or some 50 or 200 moving averages. Normally you consider that as a sign of bearishness, that is the immediate breakdown. But it is not so. We have to wait for a follow through in that system also, so that we get a confirmation whether to go for a long or a short. An immediate fall below a 20 moving average does not immediately mean that the market has become bearish. In fact, many times that can be a bottom also, because in a upward trending market there will be only some correction which may just break the 20 moving average and then start to climb high. So you must know how to make use of that so that we catch the bottom. At the same time, we filter out the breakouts. Okay, so this is what we are going to see in different time frames in different charts. Okay, we may look at Nifty, Bank Nifty in hourly, daily, then some stocks and even commodities. So what is very important is how do you look towards buying at the bottom. At the same time, how do you get out of a fake breakout systems. So that is the most important thing we have to see now. First of all, whenever you trade, you should always look at one time frame above the time frame which you choose for trading normally. Now, let us say you are taking you are doing a breakout based on day. Okay, that is daily breakouts. If you are doing a daily breakout, then you should look at weekly also. So if weekly is bullish, then on a daily breakout, then you can go for a long. Okay. Suppose if you are doing on an hourly basis, then you look at the daily basis. If daily is bullish, then hourly you can go for a bearish call. Suppose if you are doing it on a 15 minutes time frame, then you look at the 1 hour. If 1 hour is bullish and 15 minutes is also bullish, then you go for a long. So one time frame, that is whichever time frame you are taking for trading, look at one time frame higher. If both give long signals, you are long. If both give short signals, you are short. If one is long and another is short, neutral. Or if one is short and another is long, is also neutral. So with this we can to some extent, or some of the trades which gives us false breakouts can be filtered. That is one. Second thing, also in a case of a moving average or a pivot point breakout, we will see how to identify the breakouts and how to trade and filter out the fake breakout. Sorry for the disturbance. Now we are proceeding in helping you identify the trade signals clearly. Now let us say today you know that it is a bearish day. Why? How did you know it's a bearish day? Now let's look at the daily chart. Now daily chart very clear that it broke yesterday's low. It broke yesterday's low, right? And then it was a bearish day. Clear? The open is below the that is the close is below the open of yesterday. It is also below the pivot point, and it's a bearish day, right? So today we are looking at sell signals only. Okay, now there's a clear because this is broken yesterday's low, we now know that the false signals will not be there for us to go for a short. Okay, So how do you go for a short? So this all can be based on different types of techniques, but I will just explain to you that in a 1 minute now we'll go to the 1 minute or 5 minutes. Okay, so let's look at the 5 minutes, and we have already drawn a 200-day moving average, right? So the 200-day moving average, whenever it starts coming below the 200-day moving average, we will go for a short. Okay, and now let's look at this 200-day moving average. It was going up. So today morning it opened lower, and it just cut it somewhere here. So this is a slightly higher picture. That means in a 5 minutes we should not use the 200-day moving average for an intraday trade. So we should do it in a 1 minute. In 1 minute we should do the 200-day moving average. Now let's look at this. Okay, so today, since yesterday was a clear case where probably was a short position. So when today, let us say today morning it opened somewhere here. Today morning it opened somewhere here. Now, you know that very good chance that probably this will keep coming lower. But at this point of time itself, when it opened at 17,220 or something like that, this low, it went up to 220. So when you know of the 220 itself, the 200-day moving average started to come down. So you know that some stage are there. It keeps coming down. So somewhere around 270, 280 at the end. If it starts going up, probably you should wait before you again go for a short position. So here is the case. The morning you might, if you have shorted also. Okay, if you have shorted also, this becomes clearly a place where probably we need to be careful about it, because the market can start moving up on the upside itself. So what happened yesterday? Probably yesterday you would have shorted the position somewhere here, right? You would have shorted the position somewhere at 367. Let us say at 367 you would have shorted the position, and today you would have continued the trade by shorting it here, because even intraday you would have closed it here yesterday, and today you would have continued the same position here. Now what would have happened is today you would now cut the position at 311. So 367 was cut at 311. Okay. Now of course the morning itself normally there are gaps, so that makes a problem. But yesterday was 17,000 somewhere at 270. So today it also opened almost in the same place. So today is not a great bad idea. But anyway, let us say you have sold somewhere here. So this is a place where you would have put a stop loss. Now just wait for the intraday. Now you know that you are not going to be on the long side of the market, because whatever short you would have taken, because the longer time frame, whether it's an hourly or whether it's a this one, that is the daily, is very clear that it is bearish. So you need to wait for the market to come down before you do anything. So what you do is that you are waiting for it to fall. Now let's say it falls here. It falls here. Okay, so it comes to 17,320 or 324. Okay? So 333. So you are now short in the market only at 17,333. 17,333. You are short for the day. Okay, morning you have closed the position. Today you are now going short at 17,333, and right now we are very clear that we are going to remain on the short side. And if it starts gold also, we can now international commodities. Gold is 1896 right now, and gold, if you look at it, on a daily chart, normally this is not a very this one that is trend. I mean, like, there's a lot of choppiness even in daily chart in gold, but right now you can see it is on the upside, very clearly in the upside. So today anything should be taken on the upside. Anything should be taken on the upside. So that's a clarity there we have. So in hourly chart, don't go for any breakdown on the lower side. Don't go for this, because in hourly chart, in a daily chart, it is still on the upside. So in this case, now having got this, so we should look towards going on the long side here, okay, above this particular high. So right now gold is on the high side. Probably, if at all something goes wrong, we can put a stop loss, but we will not go short as far as gold is concerned. Okay, so now we look at the crude. Crude oil futures. So WTI crude in a daily chart, we'll look at the bigger picture. So the bigger picture, I think we are getting a slightly lower top, lower bottom, so slightly on the downside it's coming. So probably